Bismillahirrahmanirrahim. Assalamu alaikum. Okay, now today we have to do a balance sheet approach. We have to calculate bad debt expense under the method of under the approach of balance sheet. And under the classification of balance sheet approach, we have actually two methods. The first one is the account receivable method, and second one is the aging method. So in this video, we will actually work on account receivable method. And under this method, we will also have the same four steps. The first one is to pass journal entries. The second one is to prepare the accounts. The third one is to calculate the bad debt. And the last one is to calculate the net receivable because it is a requirement of our question. If you look and the question that we have the same values like opening balance of account that is account receivable that is 3 lakh. Allowance for bad debt opening balance is rupees 1000 and credit sales is 7 lakh. Credit sales return is rupees 10,000. Credit sales discount is rupees 20,000. Cash collection from customer rupees 1 lakh, and 2% bad debt rate on account receivable balance. And now what is the requirement? The requirement is to calculate the bad debt expense and net receivable. So let us start our question. So the first question, as we know, that is to pass journal entries, and we know that there is no journal entry for opening balance. These are only the balances which we have to write down at our ledger or T account, and all transaction has already performed of the opening balance in the last step. So first journal entries of credit sales, that is rupees 7 lakh. So our journal entry would be account receivable debit and sales credit. Here we have passed our first journal entry. The second one is credit sales return, that is rupees 10,000. So sales return debit and account receivable credit. The third one is credit sales discount rupees 20,000. So sale discount debit and account receivable credit. And the last one is cash collection from customer rupees 1 lakh. So cash debit and account receivable credit. These are the four journal entries which we have passed in our step one. So once again, I would like to remind you all that we will pass journal entries here which actually based on credit sales or credit sales return, credit sale discount. There is no rule of cash sales return, cash sale discount, or cash sales, because account receivable is the amount which we have to receive from our customers if credit sales occur. So second step is to prepare a T account or ledger of account receivable and allowance for bad debt. Now let's start our posting. Here account receivable, first you have to write the opening balance. So opening balance is rupees 3 lakh. It has been mentioning here. Now sales account receivable debit by rupees 7 lakh. There's a first entry. Account receivable credit by 10,000. So we write 10,000 here credit. Account receivable credit by 20,000. So we have to write 20,000 here. This is a third entry. Now account receivable credit by 1 lakh. So 1 lakh here, and there's a fourth entry. We have got the ending balance of 8,70,000, and debit and credit balances will balance by rupees 1 million. So this is all about the account receivable balance. Now here what we have to do in the allowance for bad debt. Under the allowance for bad debt, we have the opening balance of rupees 1,000. So we've written the opening balance of rupees 1,000. That's it. Now calculate the bad debt expense. Under the method of account receivable balance method, the formula is you have to put rate and multiply by account receivable ending balance. Now, what is rate? Rate is 2%. So we have to multiply it by what is our ending balance? Ending balance is 8,70,000. So we have to multiply by 8,70,000 here. So what would be the answer? We have to calculate 8,70,000 multiply by 2 divide by 100. Our answer is 17,400. Now, one of the most important thing which we have to learn from before the next step is that when we put the formula of net credit sales, we actually got the value of bad debt expense. But in case of balance sheet approach, we will get the value of allowance for bad debt ending balance instead of bad debt expense. This is actually the basic difference between income statement approach and balance sheet approach. Okay, let me clear. Here is income statement approach, and the method is net credit sales. In net credit sales, we put the rate upon net credit sales, and what we will get directly is a bad debt expense. Now, in another this method under the balance sheet approach, the for under the account receivable method, we actually put the rate on account receivable ending balance, and we will get allowance for bad debt expense. Now net credit sales, where this account actually fall in the financial statement. This element fall into the under the income statement part. And where the bad debt expense fall, it is also fall under the income statement part. Where is account receivable ending balance located? Under the balance sheet. And where allowance for bad debt actually located? Under the balance sheet. That's why we call this method as the income statement approach, and we call this method as a balance sheet approach. So here 17,400 is actually the ending balance of allowance for bad debt. So we put the value of 17,400 here, and we know that this is the higher part. So 17,400 would be the balancing amount from both sides. All right. Now just balance this value. Then here we will get 16,400. I'll just score it for in order to highlight. This is actually the bad debt expense for the current year balancing amount. That's it. So you just put the formula here to rate into account receivable ending balance 2% of 8,70,000, that is 17,400, and we put this value here as the ending balance, and we just balance each other, then we will get a balancing amount which will be called as bad debt expense. Now by that amount 16,400, we will have to pass our journal entry of bad debt expense, that is 16,400 and 16,400 bad debt expense debit and allowance for bad debt credit. All right, if we'll have to do our step 4, then what is the ending balance is 8,70,000, and here is 17,400. So we just subtract them. We're 8,70,000 minus 17,400. So the account net receivable is 8,52,600. So what is actually the difference between income statement approach and balance sheet approach? First difference I've mentioned here that under the income statement approach, you have selected the value on which we calculate the rate, and it belongs to income statement, and the result will be bad debt expense, which also belongs to income statement. Under the balance sheet approach, you will choose the account receivable balance method in order to put the rate on it, and this value is also belongs to balance sheet, and the resulted account allowance for bad debt expense also belong to the balance sheet approach. That's why they are called as a income statement balance sheet approach. But under the income statement balance sheet approach, that we can say under the net credit sales method and account receivable ending balance method, we will have a same number of steps. Step one for journal entries, step two for T accounts, step three for bad debt expense, and four for net receivables. But only the difference, we will have to calculate the rate, and the resultant amount will be the ending balance, not the bad debt expense, unlikely um, sales net credit sales method. And we have to pass the journal entry of bad debt expense by the balancing amount, because the balancing amount is actually the bad debt expense for the current year. But in the last step, we have to subtract the ending balance allowance for bad debt from the account receivable ending balance. We will get the net receivable amount. Thank you so much.